Hey there, financial freedom seekers. Today I'm revealing something about SCHD that most dividend influencers aren't telling you. Did you know that 73% of dividend investors overestimate the future income potential of their ETFs? That statistic is particularly relevant for SCHD, one of the most hyped dividend ETFs on YouTube right now. Whether you own SCHD already or are considering adding it to your portfolio, what I'm about to share could fundamentally change your investment approach. SCHD, the Schwab U.S. Dividend Equity ETF, has gained almost cult-like status among dividend investors. And with good reason. It offers quality companies, dividend growth, and a respectable yield at a low expense ratio. But there's more to the story that you need to understand before committing your financial future to this popular ETF. Let's tackle the biggest misconceptions I see repeatedly shared about SCHD. First, many investors believe SCHD's impressive dividend growth rate of 10% annually is guaranteed to continue indefinitely. This simply isn't true. SCHD's dividend growth is entirely dependent on the dividend policies of its underlying companies and economic conditions, not something inherent to the ETF structure itself. Second, there's dangerous recency bias at play. SCHD has performed exceptionally well during a particular market environment that favored value and dividend stocks. During the growth-dominated market of 2017 to 2020, SCHD significantly underperformed the broader market. If you're building retirement plans around continued outperformance, you might be setting yourself up for disappointment. Third, despite being marketed as diversified, SCHD has concerning concentration risks. Financial services, industrials, and consumer defensive sectors make up a disproportionate percentage of the fund. Even more alarming, the top 10 holdings often constitute around 40% of the entire ETF. That means nearly half your investment rides on just 10 companies. If one or two face serious challenges, it could significantly impact the entire ETF's performance. Another critical mistake is treating SCHD as a one-size-fits-all solution. I've seen countless young investors in their 20s and 30s dumping their entire portfolios into SCHD, which might not be optimal for long-term growth. Similarly, retirees depending exclusively on SCHD might miss opportunities for higher current income or better risk management. Finally, SCHD's yield of 3 to 4%, while respectable, is actually lower than many individual dividend stocks and certain other dividend-focused ETFs. Investors seeking maximum current income might be disappointed if they haven't done proper comparisons. Plus, depending on your tax situation, SCHD's dividend payments might not be the most tax-efficient wealth-building approach. So, what's the solution? I'm not suggesting you avoid SCHD, far from it. Instead, I want to help you use it more effectively as part of a thoughtfully constructed portfolio. Here's my step-by-step approach. First, understand what SCHD actually is. It tracks the Dow Jones U.S. Dividend 100 Index, selecting stocks based on 4 key factors: cash flow to total debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. This methodology results in approximately 100 financially strong companies with histories of consistent dividend payments. Understanding this selection process explains both SCHD's strengths and limitations. Second, tailor your SCHD allocation based on your life stage. For young investors in their 20s and 30s, consider using SCHD for only 20 to 30% of your portfolio, complemented by growth-oriented funds, international exposure, and sector-specific ETFs. For mid-career investors in their 40s and 50s, SCHD can comprise 30 to 40%, balanced with broader market exposure, international funds, and some fixed income. For those near or in retirement, SCHD can be a 30 to 35% core holding, complemented by higher yield ETFs, bonds, and alternative income sources. Third, address SCHD's sector concentrations by adding ETFs focused on underrepresented sectors like technology, healthcare, and utilities. This creates a more balanced overall exposure. Fourth, if SCHD's yield isn't meeting your income needs, implement a barbell approach. Maintain a position in SCHD for quality and dividend growth, while allocating a portion to higher-yielding options like JEPI, which has a 7 to 9% yield, Devo, with a 5 to 6% yield, SPIDE, or select REITs. Fifth, optimize tax efficiency by holding SCHD in tax-advantaged accounts when possible, or pairing it with more tax-efficient growth ETFs in taxable accounts. Most of SCHD's dividends are qualified and taxed at lower rates than ordinary income, which is advantageous. Finally, don't forget the international dimension. SCHD focuses exclusively on U.S. companies, leaving your dividend strategy vulnerable to U.S.-specific economic challenges. Consider adding international dividend ETFs like VGI IDV or DGRE for geographical diversification. Remember, successful investing isn't about finding a single perfect investment. It's about thoughtfully constructing a portfolio aligned with your personal financial journey and objectives. SCHD is an excellent tool, but like any tool, it works best when used appropriately as part of a complete toolkit. Remember, successful investing isn't about finding a single perfect investment. It's about thoughtfully constructing a portfolio aligned with your personal financial journey and objectives. SCHD is an excellent tool, but like any tool, it works best when used appropriately as part of a complete toolkit.